in the previous class to, uh, oh, okay, this is right. Yeah, so I wasn't able to upload my notes from the previous class to the portal, but I will do that. And in the meantime, I also will show it again today. So you can just revisit what we discussed last time in the class, which is the supply and demand problem. So premium and break even number. Okay. Most, I'm not sure if we'll have the time to come to that, but if we don't, we can discuss it in the next class. I thought that was in the next week actually. The risk premium and the break even number. But, okay. Mm, yeah, it's making. So Samriddhi, you're asking me to summarize what we did in the previous classes. That's not possible because we covered a lot of ground. But I think they will, I think not even will, I think they already have uploaded the previous classes, the recorded videos from the previous classes. It's there on the portal. I checked it. So please feel free to see the previous class videos. You will find everything there because we covered a lot of ground. There isn't really a simple way to cover all of it today. I hope my audio is clear. At least I'm trying to see this clear. Okay, perfect. So today I will just quickly, um, no, the recorded video sessions are available on the portal. Please scroll down in the, when you scroll on the left side, there's the panel, right? Week 1, week 2, week 3, like that. Keep scrolling down. After week 7 or something, there is a separate tab on live sessions. In that live sessions, the video for the last 2 classes, I think, is available. Yeah, week 1 and week 2 live sessions are available. Please scroll down after week 7 on the tab on the left side. Maybe I could just share my screen and show it to you. So, how many of you are not able to find the recorded video of the live sessions? Just raise your hand or something so I know. Okay, so it seems everybody is able to find it. It's just at the bottom on the left panel. So if you have missed something, or you logged in late, or you left early, or you want to recap something I explained earlier, you can revisit the videos from the previous session. Any other questions? Can you tell me which lesson covers that part which you're asking, the risk premium? I somehow thought it was in the next week. I'm not able to find it in week 3. Please respond in the group so others also know what you're replying and can answer accordingly. It was given in the graded assignment. No, but it must be there in your course content also, no? I wouldn't give it in the assignment unless it is in the course. I just can't find it where it is. Mm, okay. Okay, I will check it. If it is where in week 3 also, let me see if I'm able to find it. Just don't remember exactly what was there in your course. That's why I'm trying to understand which part of the lesson it sort of falls under. Okay, so I think it's time we can start. Okay, so one second, let me start the presentation. Okay, I hope you can see my screen. Yeah. So as always, you can join the class on the Mentimeter platform. It is you can join it by logging on to menti.com and you just use the code which is on the screen. So um, most of you would already be familiar with this. These are the instructions. Either you go to menti.com and you enter this code, or you can just scan this QR code and you can just log in. So for those of you who may not have joined earlier, this is just like an interactive learning tool where I keep sharing questions on the screen and you can respond to what you think is the correct answer during the class itself, which gives me an idea of where you might be stuck, and it gives you a sense of clarity on how much you have learned. None of this is graded, so please don't worry about how well or poorly you do in these class discussions and assignments because you're not getting marks on this. This is only for your practice. Okay, so this is just to recap. Last time we were talking about demand and supply, and I made a diagram very much like this in the class, but that diagram kind of got a little messy. So I got this cleared up, and this is sort of a similar diagram. The first diagram, if you see, so this one is when D shifts to D prime. Here you can see D is shifting to D prime. Okay. And in the second one is when there is a shift in supply. And here supply curve is shifting to the left. I'm not going to go over it all over again because I've already explained this. I'm just sharing this diagram here in the class just for your reference. Yeah. So I will share this diagram and maybe some little bit of notes along with this. Um, okay, I'll go to the next slide. It'll have the code. So this is not a question. I'm just be with it for now. Don't worry about the code just for a few minutes. So if you see in this diagram, you can see how the equilibrium has changed from E0 to E1 and from E0 to E2 in the two cases. So in the first case, when the demand is shifting towards right, there's an increase in demand. For example, like increase in demand for ice creams in the summer. Everybody can relate to that. So the demand curve itself is shifting. It's a shift in the demand. It's not moving along the demand curve, right? And in the second case, where the supply curve is shifting to the left, it's like shortage in supply of onions or tomatoes or whatever. And there is maybe because of some crop failure or something like that. So this is just to recap, and I will share this diagram and a little bit of explanation with you guys. We'll have it uploaded on the portal. I haven't sort of figured it out yet, but we will have it done in this week. Okay. Now there's a code in the on the top. Let me clear the annotation. Okay, so this is a question we were discussing last time, and I think some people were confused. So once again, what do you think is going to be the answer? The question is, the chocolate bar costs 50 rupees today. Now, hypothetically, if if you were to assume that India is facing 50% inflation, then what is the price of that same chocolate bar 2 years later? How will the price change? That is the question. So for a minute, let me just connect my whiteboard. Um, can everyone see the screen? Right. So going back to the question, I don't have the question in front of me, but let's suppose price today is 50, right? That is what the question says. And inflation, it is 50%. Inflation is applied per year, right? That's the first thing you have to remember. So what does that mean? Price after first year is equal to rupees 50 into 1.5, right? Why? Because 50% inflation means it becomes 100% plus 50%, meaning 150%, meaning 1.5. Is this calculation clear to everybody? So the price becomes 75 at the end of the first year, right? Clear? Now, price after second year. Now you'll take the starting price as rupees 75, isn't it? This is the part which I think most people kind of messed up. The price which you take at the starting of the second year will be 75, because the price at the end of first year was 50. 75. 50 into 1.5 equal to 75. Now inflation is again 50% in the second year. So that means this is 75 into 1.5. This, I believe, comes out to be how much? 112. No, that was, have I made a mistake somewhere? Sorry, 1 second. What was the question? Price was 50, right? Or did I take the price wrong? No. Okay. So this is 112.5 only. Sorry, I was doing it twice for some reason. Yeah, it's 112.5. So I don't know why I got confused. So the final answer is 112.5. This is what I think last time in the class, many of you were like not clear about as to how we got 112.5. And even today, I think a lot of people uh, answered it wrong. So that kind of sets things in perspective. So is this clear? Can I move on? Okay. So let's go back to the question now. So you can answer the question now. Good. Okay. So I think now a lot of people have arrived at the right answer. At least some people have arrived at the right answer. So remember that here we are asking 2 years later. Now, if the same question asked you what was the price 1 year later, it will be what? Can you answer in the comments? What will the price be if we ask in the same question, what is the price 1 year later? What will you answer? Good. Yes, you will answer 75. Great. I'm just making sure you understand because I'm not obviously giving exactly the same questions in your final exam from the or from the classes, but this is a practice question. So if you are able to understand this and if you're following whatever I'm teaching in the live sessions, chances are high you will not need too much preparation for the final exam. Okay, so this is the correct answer. Let's go to the next one. Now, this is a concept we will be using, and I think we already have been using to some extent. What does utility mean in the sense of, I mean, in the economic sense? When we're talking about economics, we're not talking about, um, um, everyday language. We're not talking about what utility means in plain English. So first, listen to the question. What is the economic concept of utility? What does that imply? Right. Some people have answered, I think, correctly. So once again, reminder to please keep yourselves muted unless you're actually asking a question, because I'm getting some noise in the background. Okay, Anvi, are you asking a question? No, I'm assuming not. Yes, so you were unmuted. So I have muted you. Please be mindful in the future. Okay, so somebody has answered how useful a product is. That is not exactly the meaning of utility in the economic sense. When we say utility, it's just a word we're using to imply how happy something makes you. It could be a product, it could be a service, it could be even your own savings. It could be um, you buying something, like you're spending money on something. It could be anything which we can measure in economic terms, or we would like to measure in economic terms. It doesn't even have to be a product or a service. Sorry, just give me one moment. I'll be just back. Okay. So I was explaining that it doesn't even have to be a product or service which makes you happy or satisfied. It can also just be um, what we in advanced economics call as ecosystem services, meaning like, say there is a lake in your town. It's very pretty. It's a beautiful lake. Or there is park in your locality. So all of these things, they don't sort of provide you any monetary value. Like you're not making money from it. You're not, eating it or consuming it or using it for some sort of a purpose like that. But it is still giving you some kind of happiness. It is improving the quality of your life. So even that we club under the term utility in the economic sense alone. Okay, this is not the same as the word utility in common English. That's what I'm trying to highlight. It's a very common misunderstanding where when we use the word utility in economics, a lot of times people misinterpret it or confuse it with the everyday meaning of utility, which are not the same things. Maybe in some cases there may be an overlap, but broadly speaking, they are two different things. So please keep that in mind when you are, asked different questions in economics, but even otherwise overall. And because of this misinterpretation of the word utility, a lot of times people kind of label economics as utilitarian kind of a thing, which is not the case. We study all sources of happiness, contentment, sustainability, all of that in economics. So some of you have answered correctly, whereas some of you have written usefulness, which is not really the meaning of utility in the economic sense. So all those of you who have written how useful a product is, functional usefulness, to fulfill a need, usability, purpose, they're all wrong. I'm sorry, but that is all wrong. You have given the plain English meaning of utility, not the economic sense. Ice cream, somebody's answered, I think a lot of people have answered ice cream. Well, ice cream gives you utility. Ice cream itself is not utility. Okay, happiness or satisfaction are correct answers. Contentment, benefit can be correct answers. Satisfaction from a good is an incomplete answer because it can be from anything, not just a good. Okay. Okay. So hopefully now you've understood the meaning. And okay, now we come to an important distinction between lotteries and investing. So a lot of people kind of often think that lotteries and investing both involve risk, both involve uncertainty. So what is the difference between the two? Isn't it like all one big gamble anyway? So this is an important distinction, I think, where your understanding matters. So which one do you think it is? There are four options here. Both have positive expected value, both have negative expected value. Lotteries have negative, investing has positive, whereas lotteries have positive, investing has negative. Which one? So only one can be correct. As you can see, all four options are, well, mutually exclusive. So only one of the four options is correct. Which one do you think is the correct answer? And this is like most commonly, most common um, cases. There can obviously be exceptions. There may be lotteries which are different from the general case, or investments which are different from the general case. So I think 97% of you who have voted for lotteries have negative EV, whereas investing has positive expected value. EV is expected value. You are correct. So lotteries, if you remember the slides on lotteries, as you can see, for the person who is rolling out the lottery, for person, organization, agent, whatever, for that agent to make money through the lottery, by design, lotteries are generally going to be required to have negative expected value. They're kind of relying on the fact that you will not pick that up, or you will not, know enough economics or maths to pick up that fact that on average, in general, lotteries are going to have a negative expected value. And investments on average do have a positive expected value. And while there is no like one rational reason behind all of this, you could say that investing in some sense is, you know, going to give a positive expected value on average. Again, it may not always do that, but on average, yes, because it is sort of in some sense related to, say, the growth of a company or an industry, right? So there is some growth attached to investing in one or the other, options. Whereas in lotteries, it's a zero sum kind of game. Okay, several ones of you are still unmuted. How many times do I have to repeat the same instruction? Can all of you please stop for a minute and check your mics? Are they muted or are they not muted? Anushka Kumar, can you hear me? You are still unmuted. It is really not rocket science to just check your screen, whether it is a mobile phone or a desktop, and see whether the mic button is on or off. You just have to literally put it off, unless you're actually asking a question, which I don't think any of you are. So please be mindful of this one simple instruction for this particular class. It creates a distraction, an unnecessary distraction at that. Okay, so like I was saying, lotteries are generally zero sum. Nobody is actually creating anything in a lottery, right? It's just one pool of money, which is just being redistributed. Like you're collecting a small amount of money from lots of people, right? Like thousands, lakhs, whatever. And then you're giving away certain part of it, of that pooled money to one or two people. So in sense, it is actually zero sum, right? I mean, somebody has to win and somebody has to lose. But in an investment, when you're like, buying, say, shares or whatever, you're maybe even like if you're investing in, say, a startup for that matter, you are in some sense trying to at least be a part of some kind of growth. So this is again the broad logic. It may not be there in your slides. I'm just giving you some sense of intuition of why one has positive and one has negative expected value on average. Okay, any questions? I'm guessing not. So this is the correct answer. Right. Now there are some behavioral kind of happenings or phenomena which can explain some of the things which people do in these kind of settings. So now this question is about that. So this question is saying, like, what is the term for the feeling of excitement that keeps people playing after they almost win? Like if you get a 1 rupee cashback. So if I don't know if any of you have tried this or experienced this, but a lot of these UPI payment platforms and some credit cards, they have cashback options. So, and they keep that for a reason. They want you to keep coming back to their platform. They want more transactions on their portal, right? So they keep this kind of a cashback scratch card. Even some of the shopping portals, I remember, I think Amazon, Mintra, all of these have this scratch card. Zomato, right? They all have this some kind of scratch cards, which are sometimes cashback and sometimes some other offers. And sometimes you get something, 1 rupee, 2 rupee, and sometimes you don't even get something. But what happens when you get something like a 1 rupee cashback? What is that effect for? It makes you want to keep playing. Like, maybe next time I'll win more than 1 rupee. This time my luck ran out. Next time maybe I will, um, you know, have better luck. Like it makes you think that there is a possibility that you might win if you keep playing, or if you keep, scratching that scratch card. So I think a lot of you have answered the near miss effect. what is the FOMO effect? FOMO is fear of missing out. I don't know. You guys are all Gen Alpha, Gen Z. You should be knowing this FOMO. It's not a millennial term. I'm a millennial, so this is not our term. This is your term, I think. So FOMO is fear of missing out, and it's now it's become like a recognized behavioral science phenomena or effect. Probability is, we'll come to probability distortion, but for now, let's just focus on this one question. Um, the near miss effect is what we're talking about here. Most of you have it right, that you felt like you just missed it. Like, like if you're in a race and you miss it by like a second, you feel like you just missed it. It's similar to that. That is the near miss effect. And in this particular case, that is the reason why people keep engaging. So what we are saying is that it's not like, people are stupid or something. It is just that these kind of cashback options, scratch cards, they're all designed keeping all these behavioral science phenomena and effects in mind. They purposely design it so that you will get trapped in that near miss effect and you will go on using that same portal and you will sort of keep thinking that maybe you will win the next time. Okay. So this is again an important concept, especially in risk and uncertainty kind of a setting. So we have a concept called time value of money. I don't remember in which slide, but it is there somewhere. So which means that 1 rupee today is worth more than 1 rupee tomorrow. So what all are the reasons? I think there can be more than one answer in this particular case. I'm not sure if I updated it, but I mean, just for your understanding, there can be more than one correct answers. So what all could be the reasons why 1 rupee today is worth more than 1 rupee tomorrow? What is happening to the 1 rupee? Okay, inflation does what? Somebody said inflation. What does inflation do? Um, yeah, I mean, okay, it's good you're answering in terms of purchasing power parity, but what in real terms does that mean for the value of the money? That I think somebody else has answered. It makes money less valuable, which is correct. And um, that basically means you can buy less with the same amount of money. So if you have 100 rupees today, maybe you can buy, say, one chocolate with it, 100 rupees. Maybe a year later or maybe 10 years later, you cannot buy one chocolate at 100 rupees. Right now, this may sound a bit extreme, but Anagha Garg, Shreya Sahu, can you please keep yourselves muted? Not a complicated instruction to follow. Now, for example, like there was a time when I was a kid, we could get an ice cream for 1 rupee or 2 rupee. It was very common. But obviously now you can't get an ice cream for 1 or 2 rupee. So 1 rupee has definitely lost its value. Right now it's difficult to get an ice cream even for 10 rupee. Maybe 20 rupees you can get that ice cream. So that is what we mean by the time value of money and inflation and all of that. But that is still only one option. There's only one reason. There are many reasons why time value of money matters. Why 1 rupee is worth more today than tomorrow. We're not talking about hyperinflation right now. Somebody is talking about money becomes just a paper. That's an extreme case. And hyperinflation is not that commonly found. There are many things, many measures which a government can take before they reach the situation of hyperinflation. And even there, it doesn't just happen like that. There has to be some serious problems with the economy also. So I'm not talking about extreme cases. Yes, you're talking about Venezuela. Venezuela is an extreme case. So India is not having hyperinflation. There are so many countries in the world. They're not all having hyperinflation. That is, I'm asking you to use some common sense and make a distinction between inflation and hyperinflation. We are not talking about hyperinflation here. Hyperinflation is an extreme case of inflation. Inflation is something which happens everywhere in all the countries all over the world, not hyperinflation. Okay, hyperinflation is only like rare scenarios where the economy has gone wrong in multiple ways. Okay, so the question is not about hyperinflation, please. The question is about why is 1 rupee more valuable today than tomorrow? It says tomorrow, but it could be anything else than, say, 1 year later, or 2 years later, or 10 years later, right? So that is the question. Come back to the question. So I think most of you have answered it correctly. Only the people on the chat are a little confused, it seems. So the one of these, many of you have answered because inflation makes future money more valuable. No, it doesn't. That's the whole point. You have misunderstood what the option is saying. You're saying inflation is making future value depreciate, right? That's the example I gave when I was like saying that how I could buy an ice cream for 1 rupees and I cannot even buy it for 20. I have to, like, I cannot even buy it for 10 rupees. Now it needs like 20 rupees. The same ice cream, not a different ice cream. So, future is, I mean, inflation is making the future money less valuable, right? Not more valuable. So, this is not the correct option. Many of you have chosen it. Money designs change every year. It is not a factor in deciding the value of money. It doesn't matter at all in terms of the value of the money. Because you can spend it, invest it, or lend it to earn more. This is the correct answer. Because today, I mean, the money you get tomorrow, you can only spend it tomorrow. It matters less to you. But if you have money right now, you can use it right now, right? If I want to buy something, how does it matter if you give me the same amount of money 1 week later? I want to buy something right now, right? So even if it is 1,000 rupees, I want to buy, say, I don't know, whatever. I want to buy a book for 1,000 rupees because I have to take a test in 2 days. So I really need the book today, right? If I don't have the money today, I can't buy the book. Now, if you give me those 1,000 rupees like 1 week later, now it doesn't matter. Now the test is already over. Now I don't need the book anyway. So how does it matter? I couldn't use it when I needed to use it for the thing for which I need to use it. Think of it again in terms of other things, like you have healthcare problem. You need to go and get some tests done today. You need money today. But if you get money 1 month later, it doesn't matter. You're already maybe, worse off. Your health is already deteriorated, or in worst case possible, maybe you're already dead. So, I mean, I'm sorry, that sounds like an extreme case, but I'm just trying to explain to you why the future money, the same quantity of money, even if it's like 1 month later or something, not necessarily 10 years later, it values lesser to the person, to the agent. Um, okay, so is this clear what I'm explaining to you? The time value of money is not just because of inflation, it is because having money with you right now gives you more options of how you can use it to maximize your utility, right? If I consume that money for something which is important to me, it is increasing my utility, and hence it matters more to me. Plus, the future is distant, right? I mean, 1 month later, who knows? You're saying you will give it to me 1 month later, right? Who knows whether you will actually follow through or not? And 1 month is too late for me to, I mean, imagine what I will be doing. Maybe 1 month later, I will not even need that money. So that is the other effect, which is like, um, future always feels a little further away in your vision. You don't have things planned like, that far ahead. And you discount the future a lot in your mental calculations and also in your financial calculations. Like, for example, like, um, if you get a reward today, you'll be much happier than you getting it 1 year later. 1 year later, you will be given an award. Who cares? 1 year later, I'll be happy when I get it, right? So that is not just random thoughts of a random person. These are well known, well established behavioral economics phenomena. And all of these make, money more valuable today compared with some time later, with 1 year, 1 month, 1 week, whatever. So is this clear to everybody what I explained about the time value of money? How do inflation and interest rate? Now, we are not going into that detail. I'm sorry, but this is not a part of your course because this is not something I can casually answer about how you'll need to understand money supply and ISLM to understand inflation and the Phillips curve. It's a little bit more involved than the simple storytelling I do in the class. So I'm afraid I cannot answer your question without having to go into a whole lot of detail about um, macroeconomic concepts. So we will skip that for now. I mean, it's nice that you're curious and it's good. You should study economics further if these concepts are interesting to you and if you are intrigued by how all these things happen. It's a very good thing. Unfortunately, not just paucity of time, but because at this level, it's difficult to cover all these concepts without getting a little more technical and a little more mathematical. And of course, it may not be of interest to everybody anyway. Okay, so this is the correct answer. Let's move on. Okay, now this is a numerical. You have to solve this numerical. The price of a lottery ticket is 10 rupees. There is a 1 in 200 chance to win 1,000 rupees. So now what is the net expected value for the buyer? Buyer means buyer of the lottery ticket. Okay, so please calculate it, think and calculate it, and I will answer the question. Take a little bit of time to think and then answer. Yeah, sorry, I think the screen got unshared in between. Yeah, the code is at the top of the slide. Can you use probability? Yes. Okay. I was just trying to connect actually now. Like that. Basically. So if you have the question noted, I will just switch the screen. Okay. Lottery ticket price is 10 rupees, 1 in 200 chance, and the winning prize amount is 1,000 rupees. Okay, let me share my screen here. Can you see my screen? Oops. Okay, let's solve this. Let's break this down. This is the next question. Price is rupees 10, right? Okay. One in 200, which is what? 1 upon 200. Okay. So when you're given things like chance, that is what? That means the same thing. Okay. That means that, one second, let me just see. Yeah. So when you're given things in the wording of the question, like the chance of winning is 1 in this much, 1 in 50, 1 in 1,000, whatever. That means 1 upon 50, 1 upon 200, 1 upon 1,000. And what is that? That is the probability. What is the probability that you will win? Now, sometimes you may be given the probability itself, like, this is 1 in 200, chance of 1 in 200, like in this question. And sometimes you may have to figure out the probability based on how? Based on, maybe they will tell you there are 5 winners, and then you know how many people are winning, how many people are participating. So if say 100 people are participating, or it says, suppose, I don't know, 1,000 people are participating, and there are 5 winners, that is still like 1 in 200 chance, right? So probability may be given to you in 2, 3 different ways. So whenever you're solving a question for expected value, try to find where in the question information has been given to find the probability. Okay. Now, what was the prize amount? Was, I think, 1,000, right? If I'm not mistaken. Yeah, per ticket, per person, per winner, let's say. We don't know how many winners as such. Let's say prize amount per winner is 1,000 rupees. Now, expected value or EV is equal to probability of winning into amount which you will win. Is this clear? I mean, my handwriting is nothing particularly great, but I hope you can read it. Is it clear? Only one person has given a thumbs up. Others? Great. Because this is an important concept. If you don't understand this, you may have trouble with this particular section. Wonderful. Okay. So expected value is always going to be, in these kind of cases, at least lottery and things like that, it's always going to be the probability of you winning into the actual amount which you're going to win. So now we know both the things. Probability we know from here. This is 1 in 200. And amount we know from here, which is 1,000. So this comes out to be rupees 5. Right? Now, what is your net payoff? Net payoff, or you can say net expected value, is equal to how much you have already paid versus and how much you are winning. So you're earning rupees, say 5, and you have already paid 10, minus 10, right? Because it's money going away from you is minus. Money coming to you is plus. Think of it in that way. What is coming to you, what you're earning is 10. What is going away from you, what you're giving away, what you're paying somewhere is minus. 5 minus 10 is minus 5. Oh, 1 second. I don't remember what exactly your question was asking. Um, yeah, it is asking you the net expected value, okay, not the expected value. I think some of you have perhaps gotten a bit confused between expected value and net expected value. So please be, of course, you need to know the price of the ticket. Oh, for EV, you don't need to know. For expected value of winning, no? Expected value is for the prize you're going to win. Net expected value is going to be net of what you have paid plus what you have won. So if this is confusing, I will keep in mind that I make the question a little bit clearer so you are not confused about what is being asked. Okay. But for now, I hope this is clear. Expected value, when they say just expected value, it means that you're asked about what you are winning. Expected value is of that particular lottery or gamble or whatever. Okay. And net is means net of what you have paid for it, and net of what you have paid and what you have earned or won. Okay. So this is rupees minus 5. That's the answer. And mostly usually it's going to come out to be negative. And I think this calculation is kind of shown in your slides also. Okay, so is this clear? Can I move ahead? Okay, good. So, let's go back to our questions. Yeah, so I think many of you had this answer wrong. So I hope you have understood where you went wrong in this question. Yes? So many of you answered 0, many have answered minus 10, many have answered 5, some have answered 10. A good number have answered minus 5, which is a good thing. I'm happy about that. But around more than 30 people have answered wrong also. So I hope all of you who answered wrong have understood where you went wrong now. Yes? Those of you who answered wrong in this slide. See, anyways, whatever you answer on these slides in the class, it's all anonymous. So I don't know who's answering what anyway. So it's just for your own self-assessment, self-evaluation, and for you to understand what you have understood, what you've not understood, right? So if you answer wrong in the class, it's in a way a good thing, because then when you know the right answer, you will remember it going forward, and you will bear in mind the mistake you made before. So this is the correct answer, minus 5, which I already explained. Okay. So now the next question is again on the whole phenomena of lotteries only. What is the psychological concept discussed in your lectures already, which explains why people treat 1 in a million chance as a maybe me possibility? You can think and answer. Okay, so this is what somebody was asking me earlier. about probability distortion. This is what probability distortion is. Probability distortion is when the probability is so low that you cannot imagine how low it is, right? For example, like here I've taken the example of 1 in a million. People think, like this is like some misplaced optimism kind of thing, that, oh, maybe I will be that one person in a million, because they don't understand how big the number million actually is, right? A lot of the cities in some countries won't even have a million people in them. That's how big the number million is. Some of the cities, especially in many European or other countries, some cities which are not that like big metropolises, they may not even have a million inhabitants. That is how big a number is. Imagine, like in an entire city which has a million people, you get picked. How? What is the probability of that? It's very, very low, right? But because mentally you're not able to map, like, if you go into a room of crowded people, you just think it's a lot of people, right? You don't really realize whether it's 500 or it's 1,000 or it's 10,000. Your mind is not able to grasp numbers beyond a certain point, right? You just go, say, you walk into a ballroom or, a very large hall, and you just see the room is packed full of people. You will not be able to guess how many people are there in that room. You will be like maybe 500. Maybe somebody will say maybe 1,000. Somebody will say maybe 2,000. You cannot mentally imagine you cannot sort of psychologically map the actual number to something you can familiarize, which you can physically grasp. That is the problem with 1 in a million chance. That you don't know how big a number million is, sort of. You cannot mentally imagine that. And that is why you treat a 1 in a million chance as something which could perhaps be you. Right. So that is why we call it a probability distortion, because your perspective is distorted by your ability to perceive. Your ability to perceive that probability is not there. It's not impossible, it is just extremely unlikely. See, nothing is impossible. I mean, even the Big Bang was extremely unlikely. So I'm not saying that it is impossible. The happening of the universe itself was, how low a probability that was, right? I don't remember exactly, but it was very low probability of the Big Bang happening. So, of course, even extremely unlikely events do happen, which is exactly why people believe that, this time it will be them, even if it is 1 in a million. But the fact remains that when you're putting in your money into something, it's not a good idea to put your money into something where your probability of winning is 1 in a million. This is not like 1 in a million chance where you are like, getting a Nobel Prize. This is the lottery we're talking about, right? So, um, the point is you are at risk of losing your money, your savings. So in these kind of situations, this kind of hopefulness or um, misplaced optimism is not a good thing, because you're not thinking uh, like, in a very logical way. Okay, so this is the answer. Let's go to the next question. This, I think, maybe I have already explained, but please think and answer. Okay, so this is not a very complicated question. It is just given an example of everyday mini lotteries because you are sort of, just not earning any big amount anyway. You're just winning 5 rupees, 2 rupees, like that. And uh, um, yeah, you're spinning the wheel and stuff like that. So this is not anything very complicated. So I'm moving on. It's the correct answer. Okay. There's a cat here. Please don't mind. She might want to join the class. Okay. So what should you do with the excitement that drives people to gamble? This is sort of like a concluding thought, I think, for this week's content. What is the advice given in the lesson about what you should do about, you know, like you get some kind of a rush, or maybe you get some kind of thrill or excitement from gambling. So, what should you do with that? So, there are four options. One is suppress it completely, another is channel it into productive, positive EV habits, and the other is use it to find better lotteries, and then the last is use it only active. You are sure you will win. So, I think most of you have sort of got this right. I, so, most of you have got this right. You have to channel it into productive, positive EV habits. And why is that? This is not just some moral advice, so this is good, that is bad. No, it's not because of that. It is because if you play lotteries and similar kind of gambles, you are at risk of losing money for no good reason, right? If you spend money on something and you buy something, at least makes sense. You bought a chocolate, bought a book, bought a video game, whatever. But in a lottery, you're just throwing money away just because you are not really fully calculating the expected value, which is negative, right? So the idea is that if you really like some sort of a risk or some sort of risk taking, then it's good to find other options. Now, so one person has said use it to find better lotteries. There are hardly any sort of better lotteries, so to say. Because lottery itself means that EV is anyway going to be negative, right? So positive EV habits are like, investing in something. Like, you save money and you buy, say, a laptop, or you buy a bicycle, or I don't know, whatever, something that helps you build your life, right? So invest it into things which will help you build your life. So, like, just because of momentary excitement, losing money, which can actually give you more utility, more happiness, is not a good idea. That is what the lecturer is trying to say. So, this is not like a moral science understanding of the issue. It's a very logical understanding that there are two options. You can either throw your money away in something which has very, very low probability of a win. And even if you win, it's highly likely that you will win a huge amount. And second is that you put money into something which actually helps you build your life, or to get things you really do want, or which help you, you know, um, fulfill your life goals. Perhaps you want a good education, you want to learn something, you want to pick up a new interest, a new habit, you want physical fitness, whatever, right? So you invest money, you save money, build money, grow your money, and use it for these kind of things. So I think, is this it? Yeah. So we've reached the end of the presentation, at least today on time. So there are, I think, only 2 minutes left. So if you have any questions, you can ask now. Any questions? Anyone?
Good evening, ma'am.
Yes.
Does the net expected value change from the person selling the item and the person buying it? Is there
Sorry,
anything
say again. What is your question again?
for the net expected value? Does it change according to the seller and the buyer as such?
It will change based on what the pricing is and what the price money is. Price as in what it costs to buy the ticket, and price meaning what you win. Net expected value is not like based on the personality or the personal characteristics of the buyer and seller. It is based on what is the probability of winning in a particular gamble, what is the money you're paying to buy the lottery, and what is the amount you're going to win. So you see, there are only three variables we're using. One is the probability, other is the price of the ticket, third is prize money, what you win in the end. So who is buying and who is selling doesn't matter in any of that.
Okay, ma'am. Thank you.
Sure. Was anybody else asking something? Pranav, yes, please go ahead.
Ma'am, could you explain risk return trade-off?
Risk return trade off is simply the common term for things like, there are many investment options once you go into actual investment. And I think some examples are given, like whether you buy a bond or whether you buy shares or whether you decide to become a VC or whatever. There are many ways in which you can invest. And the general thing is that, you buy or you get into some kind of an investment option where risk may be high, but the returns are also high. For example, if you're a VC, if you're a venture capitalist, you're investing in a startup, maybe the risk is high, but quite possible that the returns may also be high. And then there are like low risk, low return options, like, for example, you get a bond or you invest in mutual funds. Like, hey, sorry, my cat is a bit anxious. So yeah, so that is what it means, that a lot of the options like bonds, like what was I saying? Yeah, mutual funds, they have lower risk. So you are unlikely to lose your money, but you are also not going to earn that much. You're earning maybe very limited, right? I don't remember what is the interest rate. I haven't checked the interest rate. These are where you can check for yourself also. Whereas there are
Okay,
certain
yeah.
other options, like I was explaining, like if you want to be a VC or you want to invest in some more risky trades, then the risk of losing your money may be very high, but then but the possibility of multiplying your money may also be very high. So you may earn 10x also, and you may also lose your entire sum. It goes either
Okay,
way. So that is what it means. That,
okay, yeah.
risk return trade off means that, there are options which are high risk, high return, low risk, low return, medium risk, medium return. That is usually how it happens.
Yeah. Thank you, ma'am.
Mm. Isn't the risk similar for entrepreneurs to invest in a company or somewhere? Just sort of like, I mean, entrepreneurs obviously do take a considerable risk, but entrepreneurs are also the ones who are running the company. So, there is a definite risk, but it's not exactly the same as being a VC, because as a VC, you don't know everything about a startup, right? You don't, and you also don't have complete control over how they run or how they manage the company, the startup. Whereas an entrepreneur does. So, if an entrepreneur sees there is certain kind of losses, certain things are not working, they have the option to change it, and they have the option to revisit, do all that. Whereas a VC doesn't. VC can only choose to put money into something and maybe, nudge some changes, but they don't have any control over the operations of a startup. So there is a difference. But yes, obviously there is a risk for entrepreneurs also. Break even number depends on the context. Break even generally just means that your costs and your revenue is canceling out. You're at like zero profit. So you're getting just enough revenue to cover all your costs. That's what break even usually means. But I don't know if it is used in some other context. It may mean something else. your that insurance bit I didn't find in week 3, so I don't remember what is there in your slides. If it is relating to the risk premium part, I will discuss that in the next class because that will take some time. I don't think I have enough time to explain that today. Gaurang, Shiva Kumaran, break even means you are making just enough revenue to cover your costs. Your profit is zero. That's what break even usually means. But if it's in some other context, it may mean something else. Okay, so let's end the class here today and we'll discuss it further next class. Thank you.
About Somavara. Now give introduction for Somavarma Satrasal. Give introduction for all topics.